Hello, thank you for joining us today for this webinar on margin optimization at ECC. For those of you who don't know me, I am Nicky Chalkley. I'm the head of clearing sales at EX in London, and I'll be joined today by my two colleagues at ECC in Leipzig, Manfred Schalke, who is a derivatives specialist in the CCP risk methodology team, and Jörg Schenderlein, who is the director of clearing strategy at ECC. So today's webinar is being recorded with the presentations lasting approximately 30 minutes. We'll then move on to a Q&A session afterwards. And you'll see in the Teams function, you can write your questions into the chat function, and the questions will get published real time as we go along. And we'll do our best to answer all of those at the end. Before I hand over to Manfred, I'd just like to say one word on current market conditions. Caused by the war in Ukraine, we've seen unprecedented levels of volatility in prices. This is in turn has raised margins to very high levels at the moment. We're aware of the ramifications this has caused to you, our client base, and whilst unfortunately we can't change those market conditions, we do want to make sure all of our clients are aware of the tools that are available to make the best of the margins wherever possible. So without further ado, I'm going to hand over to Manfred now to start our presentations. Over to you, Manfred.
Thanks, Nicky, for a warm welcome. And also from my side, good afternoon and welcome to our webinar. My name is Manfred Schalke. I work in the risk controlling team, and I have the pleasure today to give you some insights on the SPAN tool, especially the cross-margining. The goal of today's presentation is to give you only some insights how to improve perhaps your margining using the cross-margining. The structure of the presentation, I explained some basics on the SPAN margining itself. Then I will explain the cross-margining, especially in comparison with netting. I have to provide some details. Also one formula, sorry for that, I'm a physicist, but I like formulas. I think that is really important to understand. I'll give you a sample calculation just to show how the cross-margining works. Okay, next slide, please. The SPAN initial margin can provide a lot of things. Essentially, it's a tool to estimate the risk of a derivative portfolio. Can do based on the derivative portfolio, you can estimate the margin, and SPAN can do a lot of things. You have a lot of scenarios you can calculate, you have to calculate, but today's focus is rather the future business, so futures, because the option stuff is rather complicated, and I will skip that in a 10-minute presentation. And in case of a future portfolio, SPAN is actually pretty simple. It's just a two-step approach. In the first step, you calculate the scan risk, that's shown on the left-hand side. And the second step, you calculate the cross-margining using the intercommodity spreads, and that's a way to reduce the margin. Okay, let's start on the left-hand side with the scan risk of combined commodities, which are essentially the products. If you have one single contract, the margin equals the scan risk of that contract, which is just a product of the lot size of your portfolio and the scanning range. The scanning range can be found on our webpage. They depend on the price and the volatility of products, and the higher the price, the higher the scanning range, the higher the volatility, the higher the scanning range. So there's not too much you can do here. Just multiply these two figures, the price, the volatility, you get the scanning range, and that times the lot size, you have the scan risk. So if your portfolio now is increasing, you have not only one contract, but a couple of contracts, the scan risk of the whole portfolio is just the sum of all the single scan risk of all contracts. So the larger the portfolio becomes, the greater the scan risk. It's all increasing. You can't do much about that. But there's some help. You can use the cross-margining to reduce the margin of a growing portfolio, the initial margin, to be more precise. The only thing which is required are opposing positions. And you also need, of course, something which really correlates. because if you have just potatoes and power, there's no correlation between, and the cross margin will not help. But later to the details. Now I will explain cross margining in comparison with netting. So next slide, please. On that slide, you can see 3 examples portfolios. On the left-hand side, it's pretty stuff that's not really cross-margining, that's only netting. So the example shown here is you have 10 futures, long German baseload power, the calendar, and you have a position of 7 short contracts of exactly the same contract. Here you don't need any cross-margining and stuff like that. It's just a simple netting. You have a margin spread of 100%. You just subtract the 10 minus 7, resulting in 3 contracts. Okay, another example is the perfect spread. If you have something like the year future, again, let's take German power, and have the corresponding quarter futures in a short position, that's called a perfect spread. You get a margin spread of 99%. We discussed actually to increase that. So the margin is pretty small, but that's also not really the focus of today's presentation. All other portfolios, so if you have German baseload power and French baseload power, or if you have power and gas mixed, or gas and emissions and all that stuff like that, you can calculate inter-commodity spreads. And how you do that is shown on the next slide. So next slide, please. So why do we do these inter-commodity spreads? Here shown in the graphics is the chart for the front month of German baseload power against TTF front month. TTF is shown with a negative sign because the idea here was to have a long position in German power and short position in TTF. So here you can see whenever the one contract increases in price, the other also increases. So because it's a short position, you have a decrease in the value of the portfolio, so that compensates each other. And would not be fair now to charge just the scan risk or the sum of all the scan risks. You have to consider the correlation between those 2 contracts. And you do that by using the formula which is shown at the bottom. So first you sum up the scan risk of both contracts. That's what I presented earlier, just the scan risk of the whole portfolio, but then you subtract the cross-margining. So cross-margining depends on the CP, which is essentially a Pearson correlation, and the minimum of both of the scan risks. And that's pretty important. And to show how important that is, I have a sample calculation on the next slide. So the next slide, please, now. Here you can see a sample calculation. It's essentially the same portfolio I showed before. It's German baseload power, here the front month, against TTF gas. I used the financial contracts. And you can see by having both these contracts, one long, one short, you can reduce the initial margin by 71% compared to the scan risk alone. How do you calculate the 71%? So the important thing is not only the inter-commodity spread. Here, that is 72%. The inter-commodity spread is shown daily on our webpage, the same page like the scanning ranges. But the important thing here is not only the inter-commodity spread, but also the relation between the scan risks of both contracts. So here you can see the formula from the previous slide again at the bottom. I used a portfolio consisting out of 10 long positions in the German baseload, but 20 TTF positions. Why have I chosen that portfolio? So TTF is twice as high. And you can see the reason by checking the formula. If you take the minimum out of both scan risks, it's pretty beneficial to have scan risks of similar heights. So here, the scan risks are almost the same, which you can see in the picture also. On the left-hand side, the black box is almost the same size as the blue box. That means the minimum of both of the scan risks is essentially just one of those because they are almost the same. and then we get the most out of the cross margining. So in my portfolio, I have 71% reduction, which is pretty close to the 72% intercommodity spread, which would be the maximum reachable. So therefore, there are two parameters you have to consider whenever you want to optimize your portfolio using cross margining. One is, of course, you have to find a reasonable future with a high intercommodity spread. But the second issue is you have to find a reasonable size of that position, because if they have essentially the same height, you get the most out of cross margining. Of course, it gets a bit more complicated if you have not only two positions, but more of them. In such a case, it's always helpful to have some simulations. You can do simulations on your own. If you need assistance here, just reach out to me. I think all the contact data will be shown at the end of the slide. So send me an email, and then we will find a way to provide you with a simulation. And if you have the need of many simulations, I can help you to create your simulation on your own. Okay, so finally, I think just get the message. You decrease your initial margin by using the cross margining, take care of the intercommodity spread, but also on the scanning ranges, and try to even that out. That's from my side. Thanks for your attention. And then, well, I have to hand over actually to myself and provide the next presentation. Next presentation is now what have we done in the last weeks or rather month to improve the cross margining. An issue we had was the delivery period, and that's shown on the next slide. So I have 3 slides now. One is just show the issue to you, and the next 2 slides is what have we done here. The issue was that all contracts in delivery were excluded from spreading until March 30th of this year. Why had we done that? Well, initially, all the contracts ECC cleared were physically delivered contracts. If you have a physically delivered contract, there are 2 issues. They can't be traded during the delivery period, so you don't have any prices. You don't have any variation margin, so there's not so much you can do about them. So therefore, they were just excluded from the spreading. We use the scanning ranges of the front month, added even the expiry month factor, and that resulted in a rather high margin requirement for contracts in delivery. It worked that for about 10 years. Nobody complained about that because, well, the positions in delivery were not that high typically, but that changed beginning the end of last year, because with these significant increases in prices and as a consequence in the margining, the margins get pretty high, pretty expensive, and put a high liquidity burden on your side. And so therefore we had to take some action here. So the sample portfolio, which is shown here with the old logic, is just consistent out of 15 German baseload contracts here in February against 10 French baseload contracts also from February. So in January, you can see you had a pretty high intercommodity spread. So in total, the spend requirement was about 500,000 for that portfolio, and about 1 million was spread away. So the nice thing is from 1.5 million scanning risk, we reduced the margin using the previously explained cross margining by 1 million. But then the delivery period started here in February. And there you can see the issue quite clear. The intercommodity spread went down from 1 million to 0, resulting in spend requirement increasing from 500,000 to 1.5 million. That's of course a challenge, and we had to take action here. And we did it. We understood that issue on your side you had, and what you did is shown now on the next slide. So next slide, please. Thanks. Here you can see the same portfolio now with the improvement. It was not put in there in February, but what would have happened if we would have been in place at that time? You can see with the new logic, you will still have the intercommodity spreads throughout the whole time. So it does not go down to zero for financially settled power and gas futures. So the nice thing here is financially settled power and gas futures are treated in the delivery period now exactly the same way we treat them in the front period or in any other period. So we just calculate a new scanning range of its own, which is different from the scanning ranges we had previously. And the important thing is now we still include them in the spreading, so you get much smaller intercommodity spreads. And that, I think, should release your margin requirements significantly. The issue here is that works for financially settled power and gas futures because they are tradable. We have prices in here and we can do that. We can't use the same methodology for physically delivered futures, but we had to do something there also, and that's shown on the next slide. So what did we do for the physical settled gas futures? Again, we couldn't include them in the intercommodity spreading. But what we had done here is we consider now the reduction in contract size. The reduction is floored by 10% just to avoid that risk, the margin going down to zero the last day of the month, because there's still some risk. That's also reducing your scan margin significantly. So you can see here one single contracts on the right-hand side. The original scan was just about, the scanning range was about 20,000 euros, and now that's going down to a rather small amount in the new logic, which is shown on the black line. The blue line shows the old scan risk. Physically settled gas futures are still excluded from the spreading. The reason is just we don't have any prices, and according to EMIR, we have to verify a high correlation if we give any credit, and we can't verify any correlation if we don't have any prices. So therefore, we just did what was possible, and that's the result. So you have now two improvements in the margining, both for contracts and delivery. One is for financially settled contracts. There we include them still in the cross margining, but we do not consider the contract size right now. That's something we discuss actually. And for the physical settled gas futures, we consider the reduction in contract size, but they still will be excluded from cross margining, and that can't be done really on short notice. The challenge here is whenever we change something, it's not only finding the model, but it also we have to build a prototype. We have to discuss this prototype with the regulators, which is sometimes takes some time because we have to provide lots of numbers there. We have to implement it, and well, then the go live is always nice, of course, because it's improvement. We are willing to ask for feedback. So if you are not happy with the margin or you think we could improve it, just let us know. Email will be provided at the end of the presentation. We're happy to discuss that margining and just ask for patience sometimes because it takes time to improve it. So these were the two steps I showed. Then thanks for attention. I hand back to Nicky.
Thank you, Manfred, for that very thorough explanation. We're going to move swiftly on to our next presentation, which is EUA as margin credits. So I'm going to hand over to Jörg now. Over to you, Jörg.
Hello, good afternoon also from my side. And after Manfred has explained to you something about cross-margining and the margin improvements, I would like to explain you on the other side of the coin about how to collateralize the margin requirement, and here in particular focus on EU emission allowances as margin credit, which has been recently improved. And maybe, but at the beginning, I would like to give you a short overview about collaterals as such at ECC and which types of collaterals are accepted by ECC in general. Could you please, yeah. Here, this slide, you see the world, how collaterals can be provided and how is the relationship. As you know, we have a three-party relationship typically in our markets between ECC, the clearinghouse, clear members and non-clear members. And there's also, of course, a flow of collaterals between the three of them. Yeah? The relation between ECC and the clear members is defined according to the ECC rules and regulations. And here, clear members are required to request at least the same amount of collaterals in collateral types accepted by ECC, but they are free to agree with their clients on the way which they use, which collaterals are accepted on their relationship. That means in the relation between non-clear member and clear member could be defined in bilateral agreements between the non-clear member and the clear member. And here the clear member could also provide additional collaterals or accept additional collaterals, what we call then as a collateral transformation. This is a typical banking service to fulfill the margin requirements with ECC. On the next slide, please, you can see an overview which collaterals are accepted by ECC from clearing members. Here we have to distinguish between the derivatives market and the spot markets. The difference has to be made because derivatives market is regulated under EMIR, and EMIR clearly specifies which kind of collaterals are accepted. And that is quite clear. Collaterals must be highly liquid, and that's why it's cash. Cash is also always accepted, always liquid. And here ECC accepts at the moment euro, US dollar and pounds only for intraday margin calls if this is not possible in euro because of the gate closure times of the payment system. We accept bonds from our clear members, which are certified and classified by the European Central Bank as eligible and which meet certain criteria, for example, a credit rating of the issuer. And this is now new. We also accept EU emission allowances as margin credit, but here also in line with the EMIR regulations, only for short positions in emissions futures. So EMIR states here is the underlying commodity could be used as collateral. For spot markets outside EMIR regulation, we have a wider freedom. Here, of course, we accept cash, as said above. We accept bonds. We accept as well emission allowances, but not limited to short positions. I come to this later in a second. And also we accept for the spot market bank guarantees. All details about collaterals and which collateral types are acceptable by ECC are listed on our website. Next slide, please. Now let's focus on emission allowances and here also explain on some examples how it works. ECC has offering emission allowances in long time, but this year we have made a substantial improvement how to use them. In the past, members have to put emission allowances upfront with ECC and have to wait 105 days until they could use this. This holding period has been waived and members can immediately use emission allowances as margin credit, and this improvement has been perceived very positive by market participants. In any case, a clear member have to confirm that kind of setup. And if they do so, emissions allowances can be used to cover up to 20% of the total margin requirement, including derivatives and spot market requirements, up to 20%. The table below shows you some examples. I hope it's for everything readable, and I try to explain it. So we have here 4 columns: the margin requirement spot, the margin requirement derivatives, the total requirement, and I computed here a potential maximum saving on the slides. Let's take the first line. First line, there's a margin requirement on the spot market only. No derivatives exposure, nothing. So the total margin requirement in this case is 10 million, taking the 20%, what I said earlier. So a member could use emissions as collateral to save up to 20 to cover up to 2 million of its margin requirement by emissions. Next example, the member is also active on the spot market. Here the margin requirement is also 10 million. He has a derivatives exposure of 50 million, but without any positions in emissions futures short. The total requirement in this case is 60 million. So taking here the 20% would be 12 million, 20%, 60 million, but he can only offset the spot margin requirement, but in this case, the full amount of 10 million. The final example in this line, here also spot margin 10 million, 50 million derivatives, but on the derivatives market, we have 5 million margin requirement for emission short. So this means also the 20% would mean here 12 million, but he can cover the 10 million spot and part of his emission requirements on the derivatives markets, leading to a total saving of 12 million. As I said, we have recently rolled this out in February, and we have received many client feedback on that. We are in continuous dialogue with our clear members to ensure that this solution can be accepted, and I think the number of clear members accepting this will grow in the next months or weeks, and then this is hopefully a normal setup for everyone. The next slides show you how it works in detail. As I said earlier, the client should speak with the clear member and check if they support the model. If they do so, then they should fill in an application form, and in this application form they have to select which kind of margin credit they want, spot market only, spot derivatives, etc. And this has been, of course, approved by the respective clear member. Once we have received the signed form, then we will do our setup in our systems, and we will inform the client once the setup has been completed. Then in the 4 steps, member have to transfer the emissions to a dedicated ECC collateral registry account at the union registry. So there is no overlap with trading activities on spot market or for deliveries of futures. Such a transfer could be performed from any registry account outside to this dedicated account, but members could also shift emissions allowances, what they have maybe purchased at the EX primary market, to this dedicated collateral account. So what we recommend to ensure that we can return the emissions swiftly, to put the ECC account, this dedicated collateral registry account, to the trusted account list of the member. After we have received the EUAs, we will record those collaterals into our internal holding systems, and the holdings also then available via the ECC member area. And from that moment, we will compute a margin credit according to the examples I explained before and according to the parameters selected on the form. And then this margin credit will then display in our daily margin reports as a margin, as a premium margin or margin credit under the respective margin classes, EMSM for spot market and SPAN, as Manfred has said, for derivatives. Next slide, please. Once you have set up, you maybe come to a scenario that you would like to have the collateral back. This collateral release is also possible, but we have to ask you here also to provide us a form and seek for approval of the respective clear member. But of course, it's important that you have to put upfront respective replacement collaterals in place, that you get the collaterals and also back. And if we receive such an approval then by your clear member, we will transfer then the holdings immediately back to you, and then you can use this for any other purpose. The clear member can only refuse a release if such replacement collaterals have not been provided to them. And finally, as I said, we will transfer the emissions back to a registry account at your choice, either on the registry layer or to ECC to fulfill your delivery obligations on the spot or derivatives market. So this is all from my side. I would get back to Nicky, and maybe then we can start with the Q&A session. Thank you.
Lovely. Thank you, Jörg. That's great. Really interesting presentations there. I hope that's been useful to everybody watching. So that brings our presentations to an end, and we're going to move on to the Q&A session now. I'm going to read out these questions that have been posted in the chat function, and then depending on the topic, either Jörg or Manfred will answer. So question number 1, which products are included in cross-margining? That's probably for Manfred, I think.
Yes, at the moment, almost all the contracts, so the energy markets, so gas, power, emissions are highly correlated, so they are all the same cross-margining group. The only exception is Japanese power. We have a separate, so at the moment, Friday is also included, but we have to discuss whether that's really appropriate. So it might be possible at some point we have a separate group for freight products. And yeah, I think these are the most important products because we have all smaller groups for the agriculture stuff.
Okay, thank you, Manfred. Next question, we've got quite a long question here, so I'm going to read it all out. It says, hi EX team, thanks for organising this webinar. Below are some questions on behalf of our traders and our treasury managers. Could you explain the rationale behind lack of decay on power prompts? This means that someone can be risk-free, but still have to deposit initial margins at the exchange. It would be good to understand the reason why this has not been implemented for power, but it has for gas. And if any estimation to put this in place, how can traders reduce the margin in this case? Can EX provide an example in Excel of how scanning risk and inter-commodity spreads are calculated for two assets? So that's Manfred.
Definitely for me, yes.
Yes.
Yeah, so we had some discussions. So issue here is the changes should not be too high when we discuss with the regulators to simplify the process a bit. So therefore, it's not the issue that we don't want to implement it, but it's always also a discussion with the regulators and with the IT to implement that. So we talk about the linear decreasing contract sizes also for power and financial gas. So I guess it will be implemented in some time. We can't provide a timeline here, but we discussed that. Regarding Excel spreadsheets, of course, I can provide an Excel spreadsheet for scanning ranges. That's actually available. I don't have one just now for the intercommodity spreads. If that's required, or can create that, I think, but that might take some time, to be honest, because that's not that simple.
Thanks, Manfred. And as we said at the beginning, our contact details will be at the end, so do feel free to reach out directly to Manfred if you'd like more details on that question in particular. Next question, will the slides be shared or published somewhere afterwards? I can answer that. Yes, they will. They'll be on the ECC website available, and also this recording will be on the ECC website and the EX TV on YouTube. Next question. How often do you update your risk parameters in IM models? How can trading houses stay ahead of those updates in order to better manage their positions given increasing costs to trade at the exchange? It's probably another one for you, Manfred, I think.
That's also for me. The parameters are updated daily. So all the scanning ranges, all the intercommodity spreads are updated daily and published on our website. At the moment, we calculate them every night and publish them also in the night. And then, well, the challenge is, of course, that you have not so much time to react to that. Another thing we are discussing is giving you one more day to be prepared to margin calls. So using more or less the previous day margin parameters for the current day. That's under discussion to give you some more time. And yeah, other risk parameters, of course, are updated rather monthly, but that's probably not really the issue you are interested in or the traders are interested in. They are probably mainly interested in the scanning ranges and the intercommodity spreads, and they are updated daily.
Okay, thanks very much. How can we access the simulation tool?
So one has to download PC span from the website of the CME. How to do that? There's a F&A question on our website. I guess we can share that link or send me an email and can show it to you. Then you have the CME span. You need the span file, which is also on our website. Then you need your own position file. The position file actually is in the member area available, and if you want to change that, you can also create some position files in an Excel spreadsheet using the so-called postconf tool, which is also available on our website. And yeah, using span, you can simulate whatever you want, essentially. And I guess if a lot of people would be interested in a session on PC span, we could organize that probably. Because you can do that on your own, and if you need help, just send me an email.
Yep, agreed. Perhaps that would be a good next demo we could record and do a presentation on that. I think that would be good. Right, next question. What is the expected impact of your adjustments on the initial margins?
That's not that easy to know, because it strongly depends, of course, on the portfolio. Overall portfolios, both changes have lead to a reduction of about 5%. I think the decay for gas is a bit smaller than 5%. For the financial power and gas, it's actually a bit more. Overall portfolios, it's I think between 5 and 10%. But as mentioned, it strongly depends on the portfolio. So some have almost no impact on their portfolios. Others were quite lucky because they had a 30 or even 40% reduction in margining.
Okay. Next question. Would it be possible to publish a scan file more than once per day? Now is usually late in the evening in order to calculate an estimate of initial margin before the end of day.
That's also my question, I guess. Yes, two issues here. One I already mentioned. We try to push the use of the span file one day back, essentially. There is another project in our company where we try to provide an estimate of the current span file, but also there I can't provide a timeline because that's not only risk controlling, that also depends on the IT department.
Okay.
But we'll discuss it.
Thank you,
and
Manfred.
We'll provide it at some point, but I can't provide the timeline, sorry.
Can positions only be considered in one inter-commodity spread, or is the calculation used for all possible spreads?
So essentially we use all possible spreads, but you can't use the same thing twice. Let's make an example. I think I had German baseload power, French power, and I had TTF. So for example, I had 10 German baseload power against 20 TTF. Let's make the example. You have 10 German baseload power against only 10 instead of 20 TTF. That would result in a smaller intercommodity spread. And to make it simple, only half of the German baseload in that case would be spread out. So roughly 5. That would mean that 5 contracts would still be available for spreading. And that's also done in span. So span essentially creates all possible pairs and then sorts them with the credit descending. So it starts with the highest credits and then breaks down the whole list until nothing is left for spreading.
Okay, yeah. Thank you. Another one for you, Manfred. Will there be a new span risk calculator available to download with changes presented?
A new span, so you can use span to download the tool. So as long as we use PC span, it's just span you can download from CME web page. And once we get rid of span, we have to provide something else, of course, but first we have to create the new model there. So as long as we use span, just PC span is the tool we use and you can download also.
Okay. This one might be for you actually, Jörg, on collaterals. Is there any thoughts of posting LCs for collateral?
Yeah, I think this is, as I said earlier, we accept bank guarantees. Letter of credits are quite similar tool. We can check this with our legal team if we can accept them in parallel anyhow. As I said earlier, they can only be accepted for spot margin requirement because Emil said that bank guarantees have been fully collateralized by cash, but this is then ridiculous. Yeah. So for spot market only, but we take this with us and check if we can accept letter of credits here as well.
Okay, thank you, Jörg. But back to you, Manfred. Are we able to see historic scanning ranges or cross margining for forecasting purposes?
So on our webpage, unfortunately, we have only the last month data available. If required, just send me an email. I can select the data, send me an email, preferably a bit more information on which data you need, because otherwise you get huge data, huge tables, which with a lot of data you probably do not need. Intercommodity spreads are a bit challenging because that's a very huge table, and even if you only need gas or power for a single country, that's still probably too much for Excel. So that's a bit challenging, but here I think the historical simulation is not really, you don't need really the intercommodity spreads because they don't change so much often. But whatever is possible, just send me an email, I will provide the data.
Brilliant. I think you'll be getting a lot of emails, Manfred.
I'm used to that.
Right, back. Another question for you, Jörg, here. Can we use EUAs as a collateral if we are not active at the EEX emission market?
Clear answer, yes, can be used. And in particular, for example, on power spot market, if you're active only on power spot market, for example, at Apex, you can use it. Yes.
Great, thank you. Another one for you, Jörg, here. Why can't you use spot EUAs as collateral also for other positions if haircut is applied?
Yeah, as I said earlier, I think you have to differentiate between spot market margin requirements and for derivatives requirement. For spot margin requirements, they steaming from power markets, natural gas spot markets can be used. Yeah, no doubts. For derivatives, we have the limitations under the EMI regulation that they can only be used as underlying of a corresponding short position. That's the use case for derivatives, the regulatory background.
Okay, and presumably that would probably answer our next question here, which is why can EUAs only be used as margin for short positions in EUAs and not for power and nat gas? So correct. Same answer, I guess. Yeah. Okay.
Correct.
Are domestic German allowances also possible for collateral?
Yeah, I think you're referring here to the national trading scheme in Germany recently implemented by the end of the year. I think we have not looked in this, but I would say no, because we have currently no secondary market. Yeah, if we would accept them as collateral, then we need also a place to sell them in case of default. Yeah, and I think this is the reason here, because this is still at the moment a primary market, primary allocation, and there's no way for us to close out then the collaterals in case of a default.
Okay, thank you. Right. Given a portfolio with different commodities, how is it determined which product of which commodities is matched with which other product from the same commodities or from a different one in order to calculate the intercommodity spread? That's Manfred, I think. I think you need to unmute yourself, Manfred. You're on mute, Manfred. No worries, we can't hear you, Manfred. Perhaps we'll just move on to another question and we'll come back to you on that one. I've got one for Jörg here. Is there a process or a way to include other banks for the acceptance of guarantees?
Yeah, I think first of all, I think you're referring to the list of banks we accept as ECC as guarantor as published on our website. Of course, there's a process. if an NCM, a client from us, would like to propose its commercial bank, we will discuss this with our risk team if this bank fulfills our risk criteria, and then we have to discuss with the bank about the wording of the guarantee. You have to say this bank guarantee of ECC is an ECC style special bank guarantee because this covers two exposures, as I explained on my first slide. It covers the relationship between the clear member and ECC, as well the relationship between the non-clear member and the clear member. So this is a special type of guarantee, and if the bank is willing to sign this, happy to onboard any bank on top as the bank as listed on the website.
Fantastic, thank you, Jörg. We'll go back to Manfred and see if we've got over your technical issues. Oh no, he's shaking his head. No, okay, all right, not to worry, no problem. In that case, I have got a question here that I think I can answer myself. What is the process to move a legacy portfolio to EX? Would it have to be blocked or EFP'd in as a new transaction? I know from speaking to our market operations team that couldn't be a position transfer, that would need to be trade registration is our terms, but perhaps you call it blocks in other exchanges or EFPs in other exchanges as a new transaction. Okay, I've got another one here for you, Jörg. Can EPEX spot members use EUA as collateral against spot margins?
Yeah, yes, of course. This was also maybe one question earlier. Yes, it's possible, and they can use, of course, emission allowances as margin credit. Yeah.
Okay, thank you very much. We've got quite a few other margin-related questions that I think would be useful for Manfred to answer, but unfortunately, we're having some technical difficulties with hearing him, and he's had to leave right now. So I think what we'll have to do is post these perhaps on our site later with the presentations as well. I think from there we'll wrap out. I've just got one last EUA question actually that's come in here for you, Jörg. You're not getting away that easily. Will there be a change on EMIR regulations regarding the EUAs as collateral for other products and commodities?
Yes, I think this will be, of course, our hope that emissions will be considered as collateral, which has a high liquid collateral. The issue is here that still the emission prices, you may all know, are under political influence. Sometimes if the government or the law is changed, the price goes up, drops. And as long as this is the case, it will be hard to convince ESMA that those prices of the emissions are really market-based. So that's why we have to deal with that. But here we are for sure in contact with the regulators. But this must be really a change in the EMIR appendix, listing them clearly as allowed collateral for any cases.
Okay, thank you, Jörg. Well, I think on that note, we'll wrap up the Q&A session here. So that brings the webinar to a close now. If any of your colleagues would like to look at this session afterwards, it has been recorded and it will be available on EEX TV, which is our dedicated content channel on YouTube. It should be published within the next 24 hours. It will also be available on the ECC website along with this presentation. Should you have any further questions, please feel free to reach out to us. All of our contact details are there right now on that slide that you can see, and we'd be happy to assist in any of those questions. So all that remains for me is to say thanks very much to everyone that's joined today. Thank you everyone as well for sending in your questions, and we hope the session's been useful to you all. Thank you and goodbye from us all. Bye-bye.
Bye-bye.